every one of us invest on stocks and equities. But when is the right time to exit from an investment? This is a very common question that often comes into a person's mind when there is a correction in the market or the market has shot up. In this video, we will learn about scenarios when we can exit our investment plans. Hello and welcome to IndianMoney.com. I am Juhi and today I'll tell you about when to exit from a mutual fund investment plan. But before we start, let me remind you that one must not exit their investment if their financial goal is not achieved. If only you have achieved your financial goal, consider exiting from your investment. Until then, continue with your SIP. For long-term investments, one must start exiting the equity-linked mutual funds and shift to a better asset class. Now let us move on and learn what is the right time for you to exit from mutual fund investments. Now the first point is a change in market situation. There can be many factors or situations for which a market changes. So in these cases, the investors require to restructure their portfolios. Now, for example, say if there is a rise in the rate of interest, then it becomes important to move from a longer maturity debt to a shorter maturity debt or vice versa. The next point that one must consider before exiting their investment is their underperforming funds. Now, if your funds are consistently underperforming, then this becomes a matter of concern for you. Now, what is an underperformer fund? Say a fund has delivered only 5 to 6% of return in 2 to 3 years. Then these kind of funds are underperformer funds. Also, a fund is an underperformer if it is behind its benchmark for 3 or more quarters by 3 to 6%. Then you need to see if this has anything to do with your strategy or theme itself. Now, for example, say Nifty 50, a fund has not been performing very well. This can be the case with every other fund also. In this case, you have to choose your strategy and accordingly you have to make a plan to exit the investment. Moving on to the next point, which is extreme market euphoria. Now, extreme market euphoria can be described as a situation when the market has already reached its all-time high. And in spite of that, the investors are investing and expecting further more growth in the movement. Now you can easily spot such kind of investments. For these investments, you can easily spot certain warning signs. Now what are these warning signs? Let me tell you. The first warning sign is the large number of growth stories without adequate proof of earning. The other sign is the instability of the analysts in providing any explanation as to why there is a rise in stock market price. Another sign can be massive oversubscription of IPOs. So if you see these warning signs, then it is a good time to redeem your investment and go for profit. Another point that one must consider, one must see before exiting their investment plan is if they have approached their financial goal. Now everyone has a different kind of financial goal. We have small investments or long-term investments only based on the financial goal that we have. Say we have to go for a vacation, we go for smaller investments, short-term investments. If we have to build a house or purchase a land or marriage, etc., then we go for a long-term investments. So basically you have to understand your financial goal and then invest, and only when you achieve this financial goal, then you move out of any investment plan. You exit of any investment plan. Now say you have achieved your financial goal. Then you can start moving your money from a riskier asset class to a safer asset class. So it's important that you manage your fund according to your financial goal and its achievements. Last but not the least, the point that you must consider before you plan to exit an investment is asset rebalancing. Asset allocation and rebalancing is a key element when it comes to investing. Now, this basically ensures that you stay under or stay within your risk tolerant limit and ensure that you move from overpriced asset class to an underpriced one. Now, a standard portfolio mix put forward by the financial planners is 60-40, where 60% is equity and 40% is bond. Now, let us assume that in the previous year, the equity had a really good growth by 30%, while when it comes to bond, it has a relatively tired growth of 5%, which means to bring the portfolio back to 60-40, one will have to sell an equity portion of 5% and simultaneously they have to buy 5% of debt. Now, a good exiting plan will require you to be ready with an equity portion. That is any mutual fund or stock that is ready for the exiting plan. Now, let us summarize whatever we have learnt in this video so far. To exit any investment plan, you must see if there is a change in any external market situation, if your fund is underperforming, if there is extreme market euphoria, if you have approached your financial goal, and asset rebalancing. That's all for today's video. Hope you understood when you can exit from an investment plan. If you want to learn more about mutual fund and investment, you can do that on our Financial Freedom app, where we have developed a course on mutual fund and investments in 6 different languages. To download the app, you can click on the link given in the description box below. If you like the video, hit the like button. If you're new to the channel, subscribe and don't forget to press that bell icon so that you get notified of every video we post. For more informative videos on stocks, investments, farming and more, keep watching IndianMoney.com. This is me, Juhi Singh, signing off. Get wise, break free.